How to protect your money from inflation. In a decade, currency won't buy the same things. The inflation causes this. The rise in prices of goods and services is called inflation. Inflation devalues money. Hedging and investing for inflation are essential. Today's events affect inflation. Energy and wage costs cause inflation. Economic inflation is natural. Outperforming the market amid inflation may hedge against it. Inflation may boost your portfolio if you monitor inflation-hedged asset classes and respond quickly in a growing economy. These inflation hedging tactics work best. Number 9. Suggestion. Treasury inflation-protected securities. TIPS, a category of U.S. Treasury bonds, are adjusted for inflation to safeguard investors from inflationary effects. TIPS disperse biannually at a predetermined rate. The primary value of TIPS fluctuates according to the inflation rate. Hence, the rate of return includes the modified principal. Although TIPS may seem like an appealing investment, some hazards are crucial for investors to consider. In the event of deflation, or a decline in the Consumer Price Index (CP), the main amount may decrease. TIPS are susceptible to fluctuations in prevailing interest rates, so selling your investment before maturity may result in a financial loss. Number 8. Leveraged loans. Corporations with substantial existing debt or a poor credit rating receive a leveraged loan as a financial instrument. These loans have a greater chance of default and hence incur higher costs for the borrower. Similar to other investments, leveraged loans include a balance between potential benefits and associated dangers. The risks associated with investing in funds that focus on leveraged loans include credit default, liquidity issues, and diminished safeguards. Borrowers of leveraged loans may cease operations or become unable to service their obligations. Publicly listed securities may facilitate transactions more easily than leveraged loans. Ultimately, leveraged loans often impose fewer safeguards for the lender compared to conventional loans. This may render a fund vulnerable to increased losses if the borrower defaults on the loan repayment. Number 7. The Bloomberg Aggregate Bond Index. The Bloomberg Aggregate Bond Index is a market index that assesses the U.S. bond market. The index encompasses all types of bonds: government, corporate, taxable, and municipal. Investors may invest in funds designed to match the index's performance. Numerous funds follow this index, including the iShares Core U.S. Aggregate Bond ETF AGG. In contrast to the S&P 500 index, which is weighted by market capitalization, where larger businesses have more positions in the index, the predominant constituents of the Bloomberg U.S. Aggregate. Number 6. Real estate revenue. Real estate income refers to revenue generated by leasing a property. Real estate performs well during inflationary periods. As inflation increases, property prices and rental charges for landlords also climb. This leads to the landlord accruing more rental revenue over time. This assists in maintaining alignment with the increase in inflation. Consequently, real estate income serves as one of the most effective methods to mitigate inflation risk within an investment portfolio. For prospective investment, consider the VanEck Vectors Mortgage REIT Income ETF MORT. As with any investment, there are advantages and disadvantages to investing in real estate. Initially, the transaction expenses associated with acquiring real estate are far more than those incurred when buying stock shares. Secondly, the illiquid nature of real estate investments means that selling them quickly and easily would result in a significant loss in value. Acquiring a home requires administration and upkeep, and these expenses may accumulate rapidly. Ultimately, real estate investment entails assuming significant financial and legal responsibilities. Number 5. The S&P 500. The S&P 500 equities have the greatest potential for appreciation over the long term. Generally, firms that benefit from inflation are those that need less capital. while enterprises involved in natural resources tend to suffer from inflation. The S&P 500 now has a significant concentration of technology and communication services companies. They represent a 35% share in the index. Both technology and communication services are capital-light enterprises, so technically, they should benefit from inflation. Number 4. Real Estate Investment Trusts, REITs. Real Estate Investment Trusts, REITs, are entities that own and manage income-generating real estate. Property values and rental yields often increase in response to inflationary pressures. A REIT comprises a collection of real estate that distributes dividends to its investors. Consider the Vanguard Real Estate ETF, VNQ, for extensive real estate exposure and a low cost ratio. REITs have some disadvantages, notably their susceptibility to fluctuations in demand for alternative high-yield investments. When interest rates increase, Treasury securities often gain appeal. This may divert capital from REITs and diminish their share values. Number 3. The portfolio consists of 60% stocks and 40% bonds. In a conservative investment strategy, a 60 or 40 stock bond portfolio is considered a secure, conventional combination of equities and fixed income. If you choose not to manage the task alone and are hesitant to pay an investment advisor for portfolio construction, consider investing in the Dimensional DFA Global Allocation 60 or 40 Portfolio I DG-SCI-X. A 60 or 40 equity fixed income portfolio is a simple and accessible investing approach. Number 2. Commodities. Commodities include a wide variety of items, including grain, precious metals, power, oil, meat, orange juice, natural gas, foreign currencies, emissions, and several other financial instruments. Commodities and inflation have a distinctive correlation, with commodities serving as a precursor of impending inflation. As the cost of a commodity increases, the price of the items derived from it also rises. Number 1. Aurum. People often view gold as a protective measure against inflation. Many individuals see gold as an alternative currency, especially in nations where the local currency is depreciating. These nations often use gold or other robust currencies when their own currency has collapsed. Gold is a tangible item that generally retains its worth. Nevertheless, gold does not serve as a genuine ideal hedge against inflation. If you like this video, please remember to like, share, and subscribe for further content.